We're going to shift a little bit, and I know we've had a series of fireside chats, and we're going to shift a little bit and get a panel. And so today we're going to talk here at the panel today about shaping the future of fair and inclusive credit. As we've seen, innovations around alternative credit options can mean the difference between financial well-being and financial hardship, whether it's paying a bill on time or facing an overdraft fee and managing your cash flow responsibly or accumulating revolving debt. Fintech innovations like buy now, pay later, AI and machine learning driven credit models are paving the way for a new, fair, and more inclusive financial future. So today we have an esteemed panelist that is going to talk to us about not only kind of how we advance a regulatory framework, but also ones that does encourage innovation, but also safeguarding consumer protection. So today we have Robin Nunn, partner at Morgan Lewis, Teddy Flo, Chief Legal Officer at Zest AI, Alex Marsh, Global Head of Public Policy at Klarna, and Kelly Cochran, Deputy Director at FinRegLab. So welcome. I'm going to start off with a question for all. As alluded to, we're at an exciting point in the consumer credit landscape. Innovation is disrupting legacy products and giving consumers alternatives to access. From your perspective, would love to figure out, tell us one way that financial technology is transforming the credit landscape for the better. Robin.
I can go first. Well, Penny, that's not really fair. Choosing one way.
Choose multiple if you'd like.
Okay. That makes me feel a little bit better because I like to ramble a little bit. Oh, I need a mic. Sorry. I don't know if you leave it on.
There you go.
Okay. I'm talking into the mic now. Sorry. Technology, right? So choose one way because I know we want to get down the row. I really think we have to tip our hat to the financial technology, especially over the past few years. It's obviously really been critical in terms of being able to quickly give everyone really access to their financial services that has been, unprecedented, I think, and needed right now in these particular times. I'm pretty passionate about closing the racial and gender wealth gaps. And I think financial technologies has a lot of real opportunity that I think we're going to get into a little bit later in this discussion that's pretty important.
I think the most important thing that financial technology is doing is leading us in engaging the groups that we are all here to help, folks that have been marginalized in the past. And that is the number one way we can actually drive change. A lot of folks have tried a lot of different things over the years without engaging communities of color, women, and the folks that really need help in financial services. And that is the number one way that I think we in this room can help drive change and increase financial inclusion.
I would say I think the most important part from financial technology is...
Everyone turn on the mic.
There we go. Is that one working? Perfect. I think the most important part actually is bringing more choice to consumers. So I think if you look at kind of the disruption that fintechs have brought, they bring genuine alternatives, more choice, but also put pressure on incumbents to raise their standards, improve the quality of their services. And I see that from our side in the buy now, pay later space, and we can talk about that in more detail in a moment. But that genuinely bringing an alternative to consumers versus, say, high-cost credit, saving the money, I think is hugely important. And again, particularly when you've got a difficult economic situation for consumers.
I guess I'll call it slightly different. Okay, sorry about that. I'll call it a slightly different aspect. In the credit space, I think one of the kind of long-term problems we've had is that too often consumers and small businesses have a difficult time. They're either turning out for credit or they're priced higher, not because they're higher risk, but because they're harder to evaluate. And I think data and technology is one way. It's not the only way, but it is an important piece of the solution to
You get to repeat it all again.
One more time. I'll focus on a slightly different aspect, which is in credit, one of the problems that we have faced for too long is that consumers and small businesses, many are either turned down for credit or they are priced higher, not because they're higher risk, but because they're harder to evaluate. And data and technology offers one way of tackling that problem. It's not the only solution, but it's an extremely important piece of really finally getting that solved.
And Robin, I'm going to turn back to you, given your background and kind of your own experience. You know, one of the criticisms that you hear oftentimes is that financial technology or some of the new emerging technology aren't regulated. But walk us back just a little bit and tell from what you know and your own background and experience, how are consumer products actually regulated today?
Yeah, I think that is a myth that they're unregulated, that is kind of percolating around in different venues. I think that, however, is sort of being stamped out with respect to this administration. I think that, as we heard from a few previous speakers about the Dodd-Frank Act and the establishment of the CFPB and the number of federal financial services regulators that are really committed to regulating consumer financial services and products, and making sure that they are unfair, not deceptive, and really available to all. You'll hear about the alphabet soup of regulations, federal regulations, and there also are state regulations that you should be mindful of. We're going to talk a little bit about the Federal Credit Reporting Act, Fair Lending, a lot of the things, Truth in Lending Act, a lot of those things relate to consumer products. Whether you are a traditional bank, whether you are a credit union, whether you're a hedge fund, whether you're whatever capacity you're in, you're not kind of removed from the commitments that we have for financial stability, making sure that there's no fraud in your products, and that making sure that you are committed to working with each and every individual who is interested in adopting financial services from you.
Great. And Alex, I'm going to turn to you. You sit at head of a global company, Klarna, and would love for your perspective, because you're working with jurisdictions all over globally, all across the world. How do you think maybe other jurisdictions look at access to credit and possibly what either the U.S. can learn or tell us some things that we might be behind?
Yeah, I mean, the two big themes that we're dealing with, one obviously is buy now, pay later regulation, and that's something obviously we've been working with the CFPB on in the US, but then similarly the FTA in the UK. There's developments at an EU level and obviously also in Australia. So, I mean, that for us, multi-jurisdictions, and I think actually a lot of commonality in terms of the journey you're seeing there, the recognition that actually consumers are shifting preference to these products, you're seeing strong growth in these products, and actually that's great, it's bringing more choice, more competition, more innovation, but you need the guardrails of regulation there to protect consumers if something goes wrong, if they have a complaint, making sure that the products are offered responsibly. So again, that for us, huge amount of focus, good to see that's progressing in the US too, from a Klarna side. We're supportive of fit for purpose, proportionate regulation. Then the other area, open banking, which we've touched on already this morning, and I think just so important in terms of that development for the access point again for consumers, that they own their data, that's their information, and actually they can choose to use that information and make that available to, for example, provide more access to credit products at a fair price. I think for too long, people have been ripped off by high-cost credit and often penalised because they don't conform with the kind of traditional metrics that feed into a FICO score or feed into a credit score in the UK. So I think those two angles for us, really keen to see, particularly on the open banking side. The interesting part there is that that's really required regulator intervention in the UK and Europe to make that happen. The banks aren't going to be voting for that one because ultimately they're giving away a lot of what they perceive to be their value, which they believe still that they own our data. And so they're not going to choose to do that. But actually I think that's where regulation can fit its dual role. One is to protect consumers, but the other side is to really support and drive competition and choice for consumers.
And Teddy, your Zest AI's business model is based on the fact of disrupting kind of that score, what it means to be creditworthy, and how to expand that definition to allow more people, more consumers to be able to be deemed creditworthy. Tell us a little bit about Zest AI's mission and kind of what you're seeing change in the marketplace.
Certainly. We are on a mission to make credit fair and transparent for everyone. Today, 50% of white people have a FICO score over 700. 1 in 5 African Americans do. And that is not driven by differences in credit risk. That is driven by legacy racism that is built into our financial system. And we are on a mission to stamp it out using better data and more math. You know, the Treasury competition report that was just released this morning, I was frantically reading it out in the hall, actually included a lot on how we can use better analytics to actually solve this extraordinarily important social problem. The way we look at it at Zest is there's really two dimensions to increasing financial inclusion. The first is expanding access. That is getting more people into the credit system, into safe, beneficial credit products by increasing approval rates, for example. So when lenders switch to a Zest AI powered underwriting system, they'll see between a 15 and 30% increase in approval rates with no increase in risk. And so that is the first element of financial inclusion, is increasing access. The second, which we're also focused on, is closing the gap. There is a significant gap in approval rates between women and men, white folks and black folks, et cetera. And what we need to do is create models, use analytics that closes that gap so people are approved at more similar rates. And so at Zest, we're focused on both dimensions of financial inclusion, and we're going to continue fighting the good fight.
And Kelly, you all at FinRegLab have done an incredible amount of research in this area, and talk about how these emerging technologies, not so much, but more established, AI, machine learning, and others, are improving that gap, that credit gap that has existed.
Sure. Well, we focused on two areas. One is the data, and the other is the analytics. Our first project was focused on the use of cash flow data, largely from bank accounts, to underwrite consumers and small businesses. And we looked at it in terms of predictiveness, inclusion effects, whether it was able to allow lenders to reach applicants who previously probably struggled to access credit, and then also fairness. And what we found was really encouraging in that respect, and that both the data was independently predictive, but that it could also be used in conjunction with traditional sources and even augment and provide more lift. So potentially really useful, not just to consumers who have no traditional credit score, but a broader range of consumers who may be accessing credit at different prices and so on, a broader spectrum. The second place that we've been focusing is on machine learning and artificial intelligence in the use of lending models. The project that we're focused on right now is really looking at how do you manage and diagnose those models. We've talked to many people who feel that there are predictive values and that potential inclusion values from using more sophisticated analytics, but if you can't manage those models, understand what they're doing, and ensure that they're kind of trustworthy and reliable, people are concerned about that and don't want to use them. So our focus has been on looking at some of the secondary tools that can be used to do that. And what we're focused on so far is both used to generate adverse action notices, which are important to consumers to understand why they have been turned down or priced at a certain level, and also fair lending. And again, we're finding that the tools are returning really important information about the key drivers of the models. At the same time, the decisions that lenders make about how to deploy the tools in conjunction with particular models, how to manage things like correlated variables and other things are extremely important. So we see promise in both delivering adverse action notices and managing for fairness to provide kind of a broader spectrum of options for lenders to choose from as they're looking at different models and figuring out how to strike that right balance and increase access over time.
And I guess a question for both Alex and Teddy. With these new technologies or the ability to determine and use a wider swath of data and being able to use it in different ways, how does that affect a company like Klarna and these available tools that are new? And then Teddy, talk about some of the partners that you work with and how they've been able to use it from a practical standpoint.
So just briefly for context to help sort of understanding, our product's quite different to say credit card. Credit card, you assess eligibility when the consumer applies. You go through quite a rigorous process there. They then get a facility and they have relative freedom there onwards as to how they spend within it. Our product, we're assessing eligibility each and every time the consumer chooses to say use Klarna as a payment method. So we believe a better model in the sense that it's more real time to their circumstances, which might mean, Teddy, I approved you last month, but unfortunately today I can't approve you because maybe your situation has changed. The steps that you're then taking within that, we will use a combination of our internal data. So, for example, if you've used Klarna before and you've missed a payment and you're currently overdue on that payment, you would be declined. So again, kind of inherent protection for consumers from building up more debt than they can afford, because you've obviously got a clear indicator right now that that might not be the best option for them. So internal data, plus we do work with the credit bureaus, so we're then using information from the credit bureaus, which we're doing to check. Interestingly, the extra part that we've been trialling more recently in Europe is to then bring open banking capability in as like a third lever that we can utilize. And that's where you can help on those marginal cases where I might say, okay, Teddy, actually, I don't quite have enough information right now to approve you, but if you're willing to share additional information, transactional data, I can get, again, a much more accurate, timely picture of your situation, both your income, but also your expenditure. I think one of the challenges, a frustration for mine with kind of the more traditional credit bureau information is just how, yes, it's incomplete, and there's more that needs to happen to get, for example, buy now, pay later data into the credit bureaus. But also there's a timeliness challenge on that data. It's typically 6 to 8 weeks out of date by the time they've gathered it from all lenders, reflected it through into people's credit files. So you think, again, I might be making a decision today based on your circumstances 8 weeks ago, and we know how quickly, particularly as we saw with the pandemic, and we're seeing now with the cost of living challenges for individuals, how quickly someone's circumstances can change in 8 weeks. So again, trying to get much more timely information, I think, is key, and that's where, again, I think open banking can be a real solution and kind of disruptor to make better decisions for consumers.
And certainly, I think that that's absolutely right, is getting more data involved in the process is really important. So a traditional credit score will rely on perhaps 25 data points about a person, maybe 30. A machine learning model is capable of using 300 or 1,000 data points about a person in order to make a decision. And so advanced analytics is really critical to using all of the new data sources that are coming available. We have to do that with respect to, while respecting consumers' privacy, while respecting their autonomy, the Fair Credit Reporting Act, and all of the other fun regulations and laws that apply. So that's one really critical area, is just utilizing more data, using more advanced tools. Another thing that we focus on at Zest AI kind of goes back to that engagement point. So we actually focus on making our technology available to credit unions and community banks, as well as Freddie Mac and other very large financial institutions. And what we're doing by doing that is you're going to the lenders that are in the local community, that know who they're working with, that know the name of the people that walk through the door of their branch, and we're helping them make better credit decisions so they can use the same tools that the very large financial institutions and fintechs are using as well. And by doing that, we strengthen the ecosystem overall. Because I think, as a point Alex made earlier, is there's room for all of us to win. Credit unions, community banks, fintechs, we are not opposed to one another. We are part of one community, and I think we can make the world better together.
And Robin, just a question for you, just to follow up on that. As the landscape evolves, as technology, as we alluded to in an earlier session, as technology kind of moves ahead of regulation or is innovating faster than a formal rulemaking process, what are some things that regulators should consider and should be looking at in terms of this access to credit issue?
Yeah, I think that is something that there's been a fair amount of discussion and attention on, and I think even Congressman Davidson mentioned that there's some upcoming rulemaking, like 1033, that we're all sort of looking at the proposed CRA rules that are taking into consideration some of the digitalization and lift in the technology space. I think we're going to see a lot more studies being done with respect to some of the big data, as well as big tech and its use of data. I think that's going to be on the forefront, and I think regulators are sort of poised in that space. I think that organizations like the CFPB have been looking at financial health for a while, but I think we're going to see a lot more, and we should see a lot more financial services regulators looking at financial health in that way. I think we're going to see a lot more look at embedded commerce and the super apps and buy now, pay later. I think we are starting to see some reports that discuss it and show that they're taking an interest, but I think we're going to eventually start to see more formal guidance in that respect, as well as along the lines of unauthorized transactions. taking a look at Regulation E, and some of the ways that we are kind of dealing with fraud, and some of the privacy issues that we're seeing popping up more and more. I think there's a lot of focus on digital assets and Web3, and I think there hopefully will be more focus on fintech and payments, and I'm hoping that's the direction that regulators will go.
And Kelly, just to follow up on that, because one of the great things that you will do with your reports is not only demonstrate and show kind of what the atmospheres might be, but provide recommendations. What needs to be going forward, or how do we need to think about things? We'd love for you just to provide, also kind of in the same line, what are some things that you think either regulators should be looking at, or things that you would propose to be able to help in rulemaking?
Well, I think all of the things you listed covered a lot of ground there. We have been doing a lot of policy working discussions around machine learning models in particular, and some of the issues that we are hearing a lot about right now is that, for instance, some of the new techniques, they give lenders a broader spectrum of choices to make, as I was talking about trade-offs between fairness and predictiveness, and how do you strike that balance. But on the other side, there's a policy question that goes with it, that now that you have more choices, how do you make those choices? And so that's clearly an area of interest. The ways that protected class information can be used in debiasing is another really important question. There are more options, and making sure that we are respectful of fair lending laws, but also getting models that are as unbiased as possible. We have kind of more choices again. So those kinds of questions are really important. And beyond that, I think the question of just how do we kind of spread the use of good practices and kind of more innovative techniques and methods for achieving greater access. We know there are pockets of real innovation going on, but there are so many lenders in this space, many of which really specialize in working with underserved communities, but they may not have the same technology infrastructure that some of the other players do. So bridging those gaps, providing certainty so that some of those lenders can also kind of find their place and decide what techniques are useful and kind of fit their models is a really important question as well.
Now, I'm going to turn to you again and go a little bit deeper on just the practicality of BNPL in particular. Where do you see the future of BNPL going? Is it at a greater adoption? Was it a flash in the pants? It was just a pandemic thing that everybody latched onto. Where do you see it, and why?
For those who don't know, it's sort of the heritage of our organisation. We were founded 2005 in Stockholm in Sweden. And actually, you can get some good indicators, well, I believe good indicators from the kind of journey that the products have taken in Sweden, 17 years on. So if you look to the US, there's lots of kind of coverage around the rapid growth of buy now, pay later over the past couple of years. The reality is right now we're looking at it representing between 1% to 2% of e-commerce payments. That's just the e-commerce side, let alone sort of bricks and mortar commerce. So still relatively modest in the grand scheme of things. You look to, say, Sweden, it's e-commerce. It's over 25% of e-commerce payments has moved to buy now, pay later. It's actually overtaken credit cards as preferred payment method. And I think that becomes an indicator of where this could go and the kind of the potential and longevity there. We believe as a fair alternative, a level playing field in the sense that the typical model, essentially you're penalising those with lower incomes, with the highest APRs, saddling them with the biggest financial challenge, whereas buy now, pay later is an interest-free option funded by the merchant, becomes a level playing field. So I think that's what's driving the consumer preference, and I think that's what will drive the longevity of the growth. I think a frustration of ours, but also something I'm optimistic about, is to drive through the regulatory uncertainty that we have, whether that's Australia, the UK, Europe, the US. Because I think at the moment you muddy two factors. It's very easy to muddy whether these products serve consumers better or not versus the regulatory standing of these products. And I think regulatory uncertainty is unhelpful. And I think a lot of what we're trying to do and working collaboratively with regulators is to drive through this stage of, putting in place, good regulation that maintains access to consumers, keeps choice for consumers. But ultimately, fast forward 5 years' time, hopefully we're through that. We're in a situation where it's purely consumers making a choice based on what's the best product for them. I think that's where I strongly believe that interest-free buy now, pay later is a better option for consumers.
And Teddy, your work is, in the expanding in credit environment, there's a lot of, I don't know, there's a lot of conversations whether or not bank fintech partnerships are a good thing, whether or not fintechs are taking over credit unions, small banks, community banks, and others. Talk a little bit about how your product actually helps and enhances the deliverability of different services in those type of banks or financial institutions.
It's a really powerful question. Small financial institutions are often at a disadvantage to really large ones. They just don't have the staff to go build a machine learning underwriting model or to, go restructure their infrastructure whenever it's necessary. But what we do is we basically take the same technology that large financial institutions have figured out how to use with their 300-person data science teams and whatnot, and we make it available to credit unions and community banks. And as I mentioned before, when we do, they're able to approve a lot more consumers, which allows more people to get access to financial products through those organizations, but it also allows them to maintain relationships with their consumers. When you deny someone credit, they're gone, right? They're not coming back. It's embarrassing. It doesn't make them feel good. They're going to go find another financial institution. But when a credit union can increase approvals, it's actually able to keep those members and continue serving them. And the other thing that the technology does is it actually helps speed up decisions in a safe and sound way with full explainability and regulatory compliance. But it allows you to speed up decision making. My inner lawyer just came out, so sorry. But in that, a lot of times, like when you apply for a loan through a credit union, there's a human with a clipboard, like looking at things and like licking their finger and turning pages. That takes time, right? And people want instant decisions. Like if you're at the car dealership, you don't want to wait 45 minutes or an hour to know whether you got approved, right? And so by using automated machine learning technology, credit unions and community banks can approve loans faster and again, improve their balance sheet and improve things for consumers.
This question is for both Kelly and Robin. Are there any inherent risks to consumers that's opening up, using different algorithms, using different data points? Is there any inherent risk that industry should be aware or be particularly noticed towards?
Sure. Well, I mean, there are risks with traditional models, and even traditional models have an array of complexity, right? This is not a new problem. But you have to think through a number of things. Is the data accurate? Is it giving you a good signal? Is it biased? Are there gaps that will systematically hurt certain populations more than others? And as we're talking about open data and data that's flowing from the consumer, there's a number of questions about privacy and security and all of those questions. So those are issues that we always face in the lending space. I think the diversification of data and kind of the increase in range of models and techniques, again, it both gives you more choices, and then you have to make decisions about those choices. So we just have to kind of work through those questions as we go along. I think when it comes to the consumer specifically, though, there's also a question about what does the consumer themselves need to know and understand. That's a space where we really actually don't have a ton of research about how consumers feel. We have some research on the data side about how they feel about using particular information. Is it fair, for instance? But when it comes to machine learning and kind of the analytical techniques, that's not a space that's been very well explored. So I think you have to think about it both from what does the consumer themselves need to know, and then also what are the protections that come from regulators, from compliance systems, from other systems that the consumer doesn't necessarily need to know all the details of that, but that to make sure that those are really robust and have been adapted to the modern environment as it continues to evolve.
I think Kelly said it really well. I must admit that I previously worked in house, and I was a bit of a novice to the alternative data world. So in, I think, around 2019, 5 federal regulators came out, agencies saying, hey, you can use alternative data responsibly. And I think, took that as a green light to, kind of look at the same 3 large credit bureaus and, look at the rent payments or electrical bills that were going in and sort of continue with the status quo. I think my new, more enlightened self thinks that the regulator should have probably put a little bit more language in that guidance and tried to talk a little bit more about the consumer protections with respect to alternative data. And allowing people to opt in to the use of their alternative data and not exclusively relying on those 3 large credit bureaus that we all know, because sometimes, garbage in, garbage out. And then also explicitly, sort of, avoiding the use of negative alternative data in addition to just alternative data. I think a lot of buzzwords come out and people kind of rush to sort of, that's the solution. I think we all agree that credit's important. I think Teddy, listed some really powerful statistics about how the history of this country has, unfairly discriminated against certain groups that make it very difficult for FICO scores to be reliable exclusively. But I think we have to probably do a better job going forward of actually using that responsible word that's in that guidance when using alternative data.
And we'll end on just a question for everybody. We'll do a quick round robin. I'll start on the other side, Robin, so it's not your first. But just, we just finished an election. We're also going into a new year. One thought as to what you're feeling positive about as far as innovation, inclusion on credit scores for the next year. Some area of innovation.
Well, I think that the 1033 rulemaking is really important. As we've talked about, the flow of data is really becoming increasingly important. More of these sources are consumer permissioned. And getting the privacy and security safeguards right is really important to the inclusion things we just talked about, because you can build all the architecture in the world. If the consumer doesn't trust it and isn't willing to turn the data on, we still will have a problem with credit access. And so I think those two things are really important tied. We're seeing the CFPB move ahead with the process now, and so that's a huge step forward for this space as well as many other financial services that are relying on these data flows.
I feel very encouraged by lots of the discussion today about the need, particularly with regulation, to balance between protecting consumers but also driving competition, innovation, choice for consumers. I think that's something that's exciting. I think if you look at some of the lessons from, say, Europe, the temptation there was just to keep layering on more and more prescriptive rules and regulations, like rule upon rule. Everything becomes so kind of constrained. And then the potential then is for the unintended consequence that in terms of trying to put so much protection in, you actually reduce choice and you actually reduce protections for consumers, because ultimately they're saddled with less choice, higher cost, poorer service. So I think I find that very encouraging as a journey towards more outcome-based regulation, focused on ultimately what experience do the consumers have.
One thing we appreciate at Zest in our engagement with various regulators is seeing how they are becoming much more nuanced in their view of these advanced technologies. For a long time, AI, ML was like evil, the boogeyman, but that's not our experience when we engage with the regulators. They're actually looking at what can be done to make this technology safe. You saw that in the Treasury report this morning. And I think they're beginning to do the same thing with alternative data as well.
Yeah, I'm feeling very encouraged after the election, on cloud 9, actually. So I think that I was happy to hear Congressman Davison talking a little bit about some of the bipartisan work that's going on. I think there's a big interest across the board in things like, buy now, pay later, understanding Web3, junk fees, competition, sort of developing ways to stop unauthorized transactions and fraud. I know that we don't always agree. I'm a Washingtonian across the line, but it really feels like there's a lot more guidance, a lot more reports, a lot more studies being done. And I recently went to a conference in LA on financial health, and there were lots of regulators. It was a full house, and I feel like people are starting to take a look at consumers as individuals and their well-being and their borrowing and their data. And if we can sort of begin to produce more studies, I know the CFPB has been looking at this for a while, but I think if everyone can start to look at the consumers as individuals, that we're going to go a long way. And I'm hopeful. I think we have a positive outlook going forward.
can I amplify just one point you made? You know, we're here at a FinTech Summit. It's fantastic, but we are talking about real people's lives here. This is a mom who needs a car to drive to work so she doesn't have to use public transportation. This is someone who has to make a big purchase that can't afford to do it all at once and needs to break it up so that they can, you know, do what they need to do in their life. And that's what we're here to do. We're here impacting and improving the lives of real people every day. Thank you.
So well. You said it so well.
Well, thank you all. It was a great panel, and I think I'm standing between you and lunch. So thank you all for being here today. Appreciate it.